Good evening, everyone, and welcome to NSF UK's first webinar in the series, Let's Talk About It, the things that matter to us. My name is Shola George. I'm the head of communications for NSF UK, and I'm one of your moderators for tonight. I'll take you through the early part of tonight's session, and my co-moderator, Remy Kayode, will come on later to take you through the latter part of the session. First, let me give you an overview. For those who may not be aware, NSF UK, or Nigerian Schools Foundation UK, is a forum for UK-based alumni associations of Nigerian schools, where members facilitate and showcase important work that they are doing in support of education, particularly back in Nigeria. Our ethos is about connecting Nigerians, promoting awareness, and developing communities. To that end, NSF UK will be looking over the next few months into a series of crucial topics aimed at supporting the community. We start off with tonight, managing your finances in a crisis, how we plan to run tonight's session. All participants will be in listen-only mode. Your audio will be muted. We have 2 speaking sessions during which you can ask questions throughout as the speakers speak using the chat option on your screen. A question and answer session will be held at the end of both sessions using the questions that you've already put in the chat screens earlier. Also, we have a couple of polls during the session which will pop up on your screens just to encourage audience participation. And at the end, we'd welcome your feedback, also using an on-screen poll. Please engage with us and let us know what your thoughts are on the session. We are also live streaming on our YouTube channel and on Facebook, and we'll be sharing the slides at the end of tonight's session. So having set the scene, let me introduce you to our speakers. We have 2 speakers tonight who between them have over 50 years combined experience in the fields of accounting and taxation. I'm looking forward to them providing us with essential tips to manage our finances during various types of crises, especially one like the one we find ourselves in now, COVID-19. I'll first of all introduce Bode Olaniyan. Bode is the CEO of Abacus 59, accountants and business advisors. Bode's expertise is in helping small and medium businesses and their owners to grow profitably, minimize tax, and manage regulatory complexity. He has held various senior management and board level roles in Nigeria, Sierra Leone, France, and the UK. He holds a BSc Honours degree in accounting from the University of Lagos and an MBA from the University of Leicester. He is a fellow of the Institute of Chartered Accountants of Nigeria, a fellow of the Federation of Tax Advisors, UK, a fellow of the Institute of Financial Accountants, UK, and a fellow of the Institute of Public Accountants, Australia. Please welcome Bode.
Thank you, Shola. Thank you for the introduction. Welcome everybody to this first in the series. And it's really a pleasure to be here with you. To start today, we will look at the following. We'll look at the current situation. The topic is about managing in a crisis, but we've already got a crisis now. So COVID-19 is a crisis. And we're going to look into the makings of this, how it started as a pandemic and has become an economic crisis. Once we've established what the crisis looks like, we'll be going into the things we can do to strengthen and build the foundation for our business or our personal finances. And the key word here is foundation. Without a solid foundation, nothing can be done. After that, I'll go through a few tips on the various actions which we can take once we've got the foundations and the plans in place in order to grow, in order to be stable, and in order to survive. Remember, the key thing is not going under during the crisis and coming out stronger. Finally, I'll look at a few of the things that have been put out by the government COVID-19 package. There have been a support package. There have been support packages all over the world, adding up to trillions of US dollars. The UK package is estimated at about 300 billion pounds as at May. And we'll look at the packages and we'll go through the various offerings out there for different businesses and individuals. My co-speaker, Akin, will come in and look at managing your money. He'll talk through the various things you need to do to manage your money and keep yourself fluid in a crisis. And then he will go into various tax tips. We shouldn't forget that it's one thing to manage our money, but the tax system gives us various opportunities to benefit within a crisis. And then finally, we'll have some conclusions. So let's go to the first slide, please. Next slide. Thank you. Like I said earlier, the current situation we're in started as a health crisis. It's got the name COVID-19, which everybody knows now. And as at today, there's over 300,000 deaths globally and over 36,000 deaths in the UK. That is a real crisis, and it's not over yet. For many, this pandemic is forecast to push the whole world into a recession worse than the 2007 financial crisis. And for those of you in the audience who live in the UK, it brings memories of that word austerity. We had an austerity from that crisis, and just as we were about to come out of the austerity, it's possible we'll be going back in again. Some grim numbers about the economic impact. 32 of the FTSE 100 companies have already deferred or cancelled dividends. Now, the FTSE 100 is the biggest 100 companies on the UK stock market. So when 32 of them, that's 1/3, have made the decision to cancel dividends, it tells us something. And by the way, most of those dividends would have gone to pension funds and a lot of other people, not just the big shareholders in the companies. In addition to that, 7.5 million workers have been furloughed in the UK as at May. For those who are not familiar with the term furloughed, it's basically put them on leave without making them redundant. It's part of the government package that companies should not make people redundant as much as possible as a result of COVID-19. So basically, the government is paying 80% of the wages for 7.5 million workers. Again, we don't know where this will end. The government is trying to encourage people to now come back to work, but there's a lot of reluctance, especially if social distancing cannot be guaranteed. Another grim statistic, 66% of UK SMEs have actually furloughed their staff. And basically, SMEs are the engine of growth of the UK. They account for about 60% of the employment in the UK today. And so when 66% of the 60% engine have put their workers on furlough, there is going to be significant economic consequences if this goes on. People are facing more and more financial challenges because, as we all know, there are people who have not been touched by the benefit packages by the government, people who are falling between the cracks. I don't know how many there are, but there are very many of them. And the point here is that it may get worse before it starts to get better. And the overriding aim by the government seems to be that without a vaccine, there has to be some balance between lockdown and social distancing. And so we hear government trying to get more people to come out to work because they don't want the economic situation to get worse. So now that we've got an overview of our crisis, which we are in now, we'll go to the next slide, which is going to look more at how we build our foundations to make our finances healthier. So next slide, please. Now, the key word here is foundation. So business foundation, personal finance foundations. I'll give an example. Sometimes you might be driving along the road, maybe on a route you take regularly, and you see construction sites come up. It usually starts with the signs saying who the owner of the land is, who the architects are, the consultants, and all the various parties involved in this project. You keep going past that site for months, and you don't see anything happening really. And if you could get into a helicopter and look at the site, you'll probably see a deep hole in the ground. All that time, all that effort, just to get the foundations right. And by the way, before you even got to the site, there was work done by architects, by structural engineers, by various other professionals to make sure that when action starts, the building is going to be fit for purpose. And then suddenly, you see the concrete and the iron rods, and the building starts to fly. And it's like, wow, this is going up so fast. And we all forget how many hours, how much money, how much resource went into the foundation. And the reason for that example is that in order to make your business or your personal finances solid and fit to withstand the crisis, there has to be planning. You have to have the foundations, and it's not something that we can avoid. In the context of crisis, there's a term that's been used over and over and again, and it's called boom and bust. Boom when the economy is growing, and bust when it's coming down. What causes the bust? It might just be that the growth was too fast and it overheated, and the bubble busts. And I think that's the origin of the term bust. In the case of this pandemic, we're having a bust that has nothing to do with the financial market. It just started as a public health problem. But the key thing to remember is that boom and bust always come and go. Years ago, or millions of years ago, when or thousands of years ago, when human beings lived at a subsistence level, you'd remember that there was famine, and then there would be rain, and there would be excess. And the key wasn't really, oh, we will never have problems or we'll never have bust. It will always come. It is a cycle. And so as part of our planning for crisis, we should actually be saying, when will the next crisis come? What do I do? Your planning actually also starts when the boom is here. What do I do when the boom is around? Do I squander what I have? And there's a very famous saying, it says, fix the roof while the sun is shining. Because when the rain comes, if you haven't fixed the roof, you'll be in trouble. So that's the mindset for managing your finances in crisis. You actually prepare for the next crisis. For the COVID-19 or for the current crisis, I would say there's been a government package worth over 300 billion pounds. But some might be making the mistake of relying on the package. And so again, I would say, what would you do if there was no government support? In previous recessions, most of the support just went to the banks, the financial sector. The first thing I would suggest or recommend is try and get your foundation solid so that even without the government support, you were able to survive and take advantage when the boom comes. A few key things in trying to make, and please bear with me, I'm going to be talking about small and medium businesses, which is my area of expertise, but I'll also try and give examples about personal finance, because there are people here who don't run businesses, who are not directors of companies, and might be more interested in how to manage their personal finances in crisis. But the rules are basically the same. You have to have a plan. Now, for businesses, we would call that a vision or a mission. And the way to explain a vision or a mission is to say, okay, if you could just close your eyes for a minute and try to imagine where your finances, where you would love your finances to be in the next 5 to 10 years. What are the things you would like to be doing? Would you want to be retired? Would you want to be the owner of your own home? Would you want to be able to take holidays when you want to? And from a business point of view, a business owner, would you want to have a business that was working without you? You've built the business, you built the foundation, and now you're probably just a non-executive director or even just a shareholder who goes in to collect his dividends. That's where the vision would start from. And then the next question will be, how do I get there? What are the things I need to do to get to that situation over the next 5 to 10 years? And in order to get there, you also have to understand what are your strengths and weaknesses as an individual, if you were building a personal plan, or as a business, what are the strengths and weaknesses of that business? Because everybody has strengths and everybody has weaknesses. And then you also need to look at what are the opportunities and threats in the environment. You can be in a line of business today. Um, let's look back 10 years when some people started business. By the way, when I started my business in 2009, many of the things going on today didn't even exist. Online software was just something people talked about, which at the time, some people saw as a threat, some people saw as an opportunity. And so those are the kind of things we have to try and look ahead when we're trying to survive in a crisis, because whether we like it or not, things will never be the same. I'll give you an example where I met with a couple of clients, and they had a shop in one of the shopping centers in the UK, and they've had to close it. But they've identified an opportunity and started an online delivery for their products. And last time I spoke to them, which was about 3 weeks ago, they were actually telling me they've done more business at this time of the year than they did same time last year. And that's just an example of trying to identify opportunities. Of course, there'll be threats. Those are the things that will prevent you from doing what you want to do. And COVID-19 is an obvious threat. Hopefully, it won't be here for too long, but it's a threat. The mindset for us when we're looking at building our foundation is we don't want to go negative. We don't want to start thinking in a negative way. So we say, hope for the best, but plan for the worst. And when you're making your plan, make sure it's a plan that can deliver the actions you want. So we now go to the actions. I have a list of a few things I would like to suggest that people do in a crisis. Something to take away is a lot of times we say, oh, we're going to do something, or we're going to get, we want to get a result, but we forget that you have to take some action. And so here I've written something that just says, remember, you can't win the lottery if you don't buy a ticket. So you have to take action. You have to buy that lottery ticket to even stand your 1 in a million chance. But without buying a ticket, it's 0 probability. So here are the key things I'd like to share with you. The most important thing is keeping our family, keeping yourself, your family, and your staff, if you're an employer, keeping them safe. And so the government's mantra of stay safe was very relevant in this case. But even if the government didn't say that, that's the first thing. If you're not safe, if your family is not safe, it's difficult to see how your finances or your business can do well. The next thing is look after the cash. And there's a popular saying that cash is king. Now, this isn't to say that all your assets should be in cash, but cash suddenly becomes king in a crisis. Imagine that there are many people out there who are what I would describe as asset rich and cash poor. When they start running out of cash, they get forced to start selling assets at half the price, a third of the price, because nobody is buying, but they need cash. And so suddenly you find people who have cash are buying assets at half the value. There's nothing wrong with the asset. It hasn't suddenly become less valuable. It's just there's less people who want to buy it. And so the price is right. So cash is king.
5
How
minutes.
do you keep cash? You need to make sure that you focus on only the important expenditure. You don't spend money on things that are not important. A few other things to think about is what we call your key performance indicators. Again, in a business, you have to understand the most important things and make sure you're able to measure them. A few other things to look at: expenses versus investments. A lot of people spend money on expenses which have no value. In a crisis, we should be looking at investments, and we should be focused on the return on that investment. Risks against benefits. Every investment has risk and every investment has benefits. It has been said that the risks and the benefits are like twins. Someone came to you and said, oh, there's so much benefits in this and there's no risk. That's a lie. Your job is to find that risk. And again, we've got to convert our to fixed costs versus variable costs. Fixed costs are costs where you have to spend the money whether there was any income or not. You've got to find ways of breaking down those fixed costs and only having as much of variable cost as possible. And again, another one here is you might want to downsize. I've got good examples of clients who are very big, had factories, many employees, and were not making any money after they paid all the salaries, paid the tax, paid the landlord, paid everybody else, and they just had nothing. And they downsized, and they're very, very happy with the profit they make. So let's go to the next slide. Yes, so once we've looked at all the things we could do to try and hold on to cash and manage our finances in a crisis, we can now say, all right, the government has given us some packages. Which of these packages best match my goals? Remember, we didn't start with the packages. We're just trying to look for the packages that match the goals. And I've got a list of the various packages here. And there's what they call the job retention scheme for companies who are still solid but cannot open to the public, where your 80% of your workers' salaries will be paid. There's a similar scheme for self-employed people. It's called the Self-Employed Support Scheme. The government has given grants to SMEs. There have been grants to various sectors of the economy. Okay, like hospitality, retail, and leisure. There are bounce back loans, and there are also programs for deferral of tax. So as we come to the end of this, I would just say, in summary, what we're looking at in managing our finances and our business is, first, build the foundation plan. Make sure you're able to hold on to your cash. And most importantly, stay safe for you and your family. So thank you so much for your time. If anybody wants to discuss any of these issues with me, you can contact me. My phone number is on this slide and my email address. And we'll give you what we call a free business test drive. We will pick one of the most important or pressing issues in your business, and we will try and find a solution to it with you. So thank you, everybody, for your time, and have a nice evening. And I hope this has been of benefit to you. Bye.
Thank you so much, Bode. That has been quite an enlightening session. I mean, as I said earlier, people are free to put questions into the chat box, even as the speaker is speaking, and we'll be able to pull together those questions at the end to ask both Bode and our next speaker, Akin. I'll just also ask if you could just direct, when you put your questions in, just say which of the speakers your question is directed at, so that we can direct those questions better for you. So I'm going to introduce our next speaker. His name is Akin Koka. He is a partner in Buzzacott LLP, and he also heads up the private client team of Buzzacott. Akin's focus is on wealth preservation from a tax perspective. He helps high net worth individuals and their families protect their wealth throughout their lives through careful planning. Akin is a member of the Association of Taxation Technicians and is a qualified chartered tax advisor. Please welcome Akin Koka.
Thank you very much, Shola, and a very good evening to you all. I'm going to start with some general tips and then segue into some more tax-specific things. And first of all, just make the point that from my experience, small adjustments here and there really can make a big difference over time. So managing your money. First thing I wanted to just touch on is liquidity. Now, I know Bode has already talked about cash being king, but it is important to hold on to your cash where possible in times of uncertainty. And if not cash, then certainly you want assets that can be easily converted to cash. And a very good example is possibly not spending a lot of money now on home improvements or splashing out on a new car. It's also important to review your expenditure. Understand the difference between wants and needs. And when you're doing this, you need to cut out the sentiment because it's not always obvious what is a want and what is a need till you really give it some thought. Look at utility deals. So I'm talking about your gas, electricity, telephone, TV, satellite, things like that. And then create a simple budget. So you don't need anything complicated, overly complicated. You don't need expensive software. A spreadsheet will probably suffice. And what you're really looking to do is capture your income coming in over a period of time, whether it's a month, and you want to look at the expenses going out. It's also important to have in this budget one-off expenses. So you plan for one-off expenses and then create a buffer for unexpected expenses. So you want to leave some of the expenses unallocated. And once you've made a budget, it's important to stick to it. So no impulse buying. It's also important at times like this to use credit wisely. So credit may be needed at a time like this, but think of a credit sandwich. So the first slice of the sandwich is when you're trying to obtain credit and they put you through all the hoops and endless questions. And it's quite obvious at that stage that it's not your money. Then you have the middle bit of the sandwich where the credit is approved and you've got control of the funds. And it's easy to think at that point that it's your money. But then you come on to the final slice of the sandwich, which is the period when you're required to pay back the credit. And then again, it becomes clear that it's not your money. So it's really important to manage that process. It's also important to review interest rates and payment terms. And check to see if there are any deals going. If you file tax returns, then try and file your tax return early. At least it will give you an idea of whatever tax you've got due so you can plan towards it. Or even better still, you might be due a refund so you can claim your refund sooner. It's also important if you're going to achieve all of these sort of things that I've talked about, that you keep good records. Could I have the next slide, please? So it's important not to let the tax tail wag the investment dog. There's so much more to tax planning than just reducing tax. You have to combine it with wealth management as well. I put in this quote from Benjamin Franklin because no one likes paying tax. But taxation is not going away. And if anything, there's going to be more tax over the coming years because the government have to find a way to recoup some of the huge funds that Bode referred to earlier on. So make sure your tax affairs are in order. The trick is not to pay any more tax than you need to, but you need to be mindful of tax evasion and tax avoidance. I'll start with tax evasion, which is illegal. So tax evasion can lead to huge fines or in extreme cases, even a prison term. And HMRC have the power to go back 20 years if there has been an irregularity. Tax avoidance, on the other hand, is legal, but there are shades of grey. Tax can be very complicated. There are some questionable schemes being marketed at the moment, some of them even targeting NHS workers. And there's also lots of complex anti-avoidance legislation. So make sure you get an expert to help you. Just a few things on capital gains. If you're selling assets, then use your capital gains tax annual exemption. That is currently £12,300. And married couples should make sure they utilize both allowances. So if you were going to sell an asset, you'd want to sell it in joint names so that you could take advantage of both annual exemptions. Don't waste your capital losses. And one of the problems with trying to keep capital losses is that if you have gains and losses in the same tax year, they're netted off against each other. And that way you could end up wasting not only your personal allowance, but your loss as well. But you could take advantage of this time to look at your investments. And if you've got any investments that are underwater, you can crystallize those losses so that those losses are carried forward and not wasted by setting them off against gains. Another good thing to do is to check your tax code. Sometimes you could have old benefits or taxable things still included in your code, and claim tax reliefs that are due to you. And I'll give you a few examples. There's tax relief due on payments into qualifying pensions, and I'll talk a bit more about that in a few minutes. Gift aid relief on payments to qualifying charities. There's rent-a-room relief, so you can claim up to £7,500 if you have a lodger. And this applies where you rent a room in your home, a furnished room in your home where you live. And if you have a property but you don't have much by way of expenses, you can claim a property income and allowance of £1,000. Very important for married couples to try to equalize their marginal tax rates. So for example, if one spouse is a 40 or 45% taxpayer, try and spread your income bearing assets across both spouses so that you can use both of your personal allowances and your basic rate bands. Could I have the next slide, please? Just a little on tax efficient investments. So the first one up is an individual savings account, an ISA, and all interest, dividends, capital gains on funds held within an ISA account are tax-free. You can have different types of ISAs, stocks and shares ISAs, cash ISAs. The annual limit is 20,000, and a junior ISA for children has an annual allowance of 9,000. I put in a line there on BED and ISA because for people who already have investments but maybe don't have them in an ISA, you can use BED and ISA to get those investments into the tax-free environment of an ISA. And you do this by selling the shares, putting the proceeds into an ISA, and then immediately buying back the shares in the ISA. And you can do this gradually so that every year you're making use of your capital gains tax annual exemption. Now moving on to pensions. The best and easiest way to plan for your retirement is to start as early as possible. That's perfectly logical. And there's tax relief available for payments into a pension, subject to the limits. So the annual limit is £40,000, but that annual limit is reduced down to £4,000 per annum, where income exceeds £312,000. And I've been reliably informed that Bode is only entitled to £4,000 per annum. So I'll let you work that out. You can also carry forward any unused relief for 3 years. And another important point as far as pensions are concerned, make sure you're claiming additional relief if this is due to you. So when you make a pension payment, you're usually making the payment net of 20% basic rate tax. And that 20% is added to your pension pot. But if you're a 40% or 45% taxpayer, you have to claim the additional relief. Just trying to think who that would apply to. It's likely to apply to most people earning approximately £50,000 per annum or more. Right, could I have the next slide, please? Just a little bit on state pensions. Now, this is something that is often overlooked. And it's something that I'm a lot more conscious of now than maybe I was when I was younger. So the first thing to note is that you need 10 qualifying years on your national insurance record. So 10 years of paying enough national insurance to get any state pension. You need at least 35 qualifying years to get the full pension. And if you're somewhere between 10 and 35 years, you'll get a proportion of your state pension. Now, sometimes you have gaps in your national insurance records, and that could be for a whole host of different reasons. So it could be because your income is so low as to be below the threshold. It could be because you're unemployed, or possibly because you have a company and you only draw dividends, you don't have a salary, or you have a very small salary such that you're not paying enough national insurance contributions. But if you have a gap in your national insurance record, all is not lost. So what can you do? So you can make voluntary contributions to fill some of those gaps. You usually can't go back more than 6 years. So what you would need to do is get details from HMRC of how many qualifying years you have and which years they are. And when you look back over 6 years, if you have any years that don't qualify, you can make voluntary contributions. You can also make voluntary contributions if you just don't have any income, or your income is low. So you can just decide to make voluntary class 3 national insurance contributions, and that way you'll be able to build up your qualifying years towards a state pension. So it's quite easy to do, and certainly worth doing. And as I said at the beginning, all of these little things add up over time. So that was a very quick canter through my planning tips in the 15 minutes that I was allotted. But I'll be happy to take questions if anyone has any questions. But thank you all for listening.
Oh, thank you very much, Akin. That was a really insightful presentation. As I said earlier, I'd like to now pass you all on to my co-presenter, co-moderator, Remy Kayode, for the latter part of this session. Remy, over to you. Remy, do you want to unmute yourself?
Thank you, Shola, and good evening again to everyone. Let me start by saying thank you again to our presenters tonight. I think that's been very illuminating, the information that they have given. Just before we go into the session for questions and answers, I'd just like to remind us that this session, this webinar, is actually being recorded, and it will be available on our NSF website in the next few days. It is also being live streamed to our Facebook group and YouTube. So, got some few questions for you. The first one is for Bode, and it says, in what ways can one invest his personal finances? Very briefly, please, Bode.
Personal finances. Basically, I'm not an investment manager, but the overall thing in investing is to remember that what I mentioned about risk and return. You have to be clear about how much risk you want to take for your return, because risk and return are like twins. If you want to take high risk, you can get high returns. If you want to take low risk, you will get low returns. So that's the first thing you need to establish. And basically, I'll give a simple example. If someone was about 5 years from retirement and decided to take high risk, I would say they were mad. Younger people can take higher risks because they have enough time to make back any money they've lost. But one of my preferences is property for a long-term position, if you're going to be there for the long term. So that's what I would say there.
Thank you. I've got a question, actually two questions rolled into one for you, Akin. One says, how do tax code work? And in addition to that, what sort of tax should you be looking at when starting a small business?
Okay, I'll take the first one. So a tax code is basically what is used to determine how much tax is actually taken out of your pay every month. So it will include whatever tax-free allowance you're entitled to, and it may include other reliefs like gift aid, pension relief, if you're entitled to them. It may have some of your other income that it is taxed. So if you have bank interest or a taxable benefit like a company car, so that could be included in your code as well. And all of these are then used to determine how much tax is deducted from your salary each month. So that in a nutshell is how a tax code works.
Thank you.
The second question was what tax you pay when you start a business?
Yes. What sort of tax should you be looking at when starting a small business?
I will assume that what that question is really asking is the choice of business vessel. So you could be a sole trader if you were with someone else in partnership or set up a company. I would say a general rule of thumb is if you're starting out small. If you're not exposed to huge risk that you're looking to protect yourself from, the easiest thing to do is start out as a sole trader, simply because you have the option of incorporating later on if you need to. If you're starting out in a higher risk area and there is need to protect yourself, then you might want to start out straight away with a limited company, which offers a form of protection around you. Another reason why sometimes you may opt for a company is it affords you the opportunity to draw dividends rather than a salary, and maybe make some savings on national insurance. So I think a lot depends on individual circumstances, the sort of sums involved, and the level of risk that you're exposed to. I hope that helps.
Thank you, Akin. I've got another one for you, Bode, and I'm going to try and tie it with another question that I've got here. This says, how does an employed person apply the ideas you talked about in their finances? So an employed person, how will they be able to apply the ideas you've talked about in their finances? And can I also quickly tie that in with the question that says, how does COVID-19 job retention scheme work? Very briefly, please.
All right, the first one, how does an employed person apply the ideas? Well, basically, employed people still need to have a goal, a vision. Where do you want to be in the next 5 to 10 years? And so you've got to also invest. If a very important question, because there's not much time, is to say, how will you live when you are retired and no longer an employed person? That's a very important question. And therefore, you'll have to bring in things like pensions. You might have to invest in property. You might have to invest in, have cash funds. And so a very important question, how will you live when you are no longer employed? So a lot of those things will be applied to it, including planning. The second question, what was the second question, please?
The second question is, how does COVID-19 job retention scheme work?
Yes, basically, when the pandemic hit, the government was asking people to go and stay at home. Many people said, look, I can't go and stay at home because I have to make money. And so the government came up with the idea of telling employees who otherwise might have fired a lot of workers that don't fire don't fire workers if you think your business is still viable. Of course, if you think your business is going to die, then that's a different question. If you put people on furloughed leave, that means they sit at home and they don't come to work. The government will pay that company 80% of that salary to pay to the employee. The company can top it up and pay the additional 20% if they have the funds, but the government will put in 80%. So that's how the scheme works. And the assumption is that if that employee was not paying for travel, was not going to work, was not having lunch at work, the 80% might be sufficient as a replacement for the 100% they used to receive. This scheme has been extended till October. It was up till June. It's now been extended till October, but there are a few modifications which haven't yet been announced.
Thank you, Bode. Akin, I'm sorry, but I'm going to have to give you these 3 questions within the time that we've got so that you can answer them. They're kind of all related anyway. So the first one says, how do you make the voluntary contributions? Will they be large payments or small payable amounts? Tying with that is, when you say voluntary contribution, does this mean I am missing £600 and I can pay £100?
Okay.
And I've also got, sorry, let me just quickly give this one to you. It says, can you give a bit more information about married couple allowance, please? Married couple tax, please. Thank you.
Okay. All right, just taking the first one and trying to roll them into 2. So the likely scenarios with national insurance records and not paying enough is when you contact HMRC, they will provide a list of the years where you've paid enough and years where you haven't paid enough. In the years where you haven't paid enough, it's possible that you haven't paid anything at all for that year, or you've paid some, but just not enough. So if you've paid some and not enough, or you're just topping up, and that will be a factor of how much you've paid. If you haven't paid for that year at all, then they will confirm the amount that you will need to pay for that year. So that's how you fill in the gaps where there are missing, there's some years that are incomplete. Where you are just choosing to make voluntary contributions because you don't have any income, then you're just paying a flat rate class 3 national insurance contribution, which I think is currently about £15 a week or something. But that information is readily available on the HMRC website. I hope that covers those 2 questions. And then just on the question about married couples, the point I was making is that where you have a married couple, you can take advantage of the fact that you can pass assets in most circumstances between spouses free of tax. And so what you're trying to do is make sure that whenever you're selling something, you're using the reliefs, because each spouse will be entitled to a relief. So in the capital gains tax example, that would be 24,600 instead of just 12,300. So what you would do is make sure that that asset was a joint asset before you sold it. And you could do that if it was in one person's name by transferring half to the other spouse. Now you need to take advice in doing that, because there are some limited circumstances where that could itself trigger a tax charge like stamp duty. But that's a very rare situation. Similarly with income, if you have one spouse who is already paying 45% tax, and you have the other spouse not even using up their personal allowance, then if you have, say, for example, a buy-to-let property, or you've got some investments, then you want to consider whose name that property should be in, so that you're using the personal allowances for both spouses. And also you want to use up your basic rate bands, i.e. your 20% bands, before you start paying tax at 40% or 45%. I hope that answers your question.
Thank you very much. Once again, I want to thank our presenters for answering those questions very brilliantly. As some of you know, we've got a series of topics to cover later on during the different months, and it's all about let's talk about it. Tonight have been very illuminating, I would say. We have been informed of the fact that there is always a cycle of boom and bust. And an important issue is that we need to prepare for either of these when it does occur. It is essential to learn that we need to take action for growth and for stability after crisis. Bode has recommended the need to establish our vision and mission as individuals, as employees, or as employers. And we need to think strategically, both at the personal level and at the business level. And that also includes looking after our families, ourselves, and of course, our staff, if we have any. We've also been appraised by Akin that we need to review our expenses. We need to set budget. It's very important that we review that budget every so often, whilst at the same time, we begin to make small changes here and there. All of that will help us to survive in the times of crisis, whether as a person or as a business. We're also made to be, to realize that we need to make wise decisions when getting into credit, and we should be good with keeping records. It has been said by Bode that we need to plan for the worst, but we hope for the best. You will agree with me, ladies and gentlemen, that it's all about developing strategies, all about setting up smart plan and taking actions. And with all that we have heard tonight, I am sure we all have a take home or two from this session. And so it will make it easier for us to set strategies and to put plans in place. And of course, that will help to be able to manage our finances in crisis. Please remember that this webinar has been recorded, or is recorded as we speak, and it will be on our website later on in the course of the week. Before we go, we've got some questions because we'll like feedback from you. So please kindly complete those questions as they pop up on your screen. Thank you. So just make your decision. Session was delivered. I received what I expected. Subject matter was presented effectively. Strongly agree or disagree. Okay. So, ladies and gentlemen, I want to believe that you've had a useful session tonight. Please book the dates that you can see on the screen in your diaries. The 26th of June is the next one, and we're hoping to talk about staying safe in a digital world. Thank you very much for your time tonight. Have a good evening, and God bless you.